This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Serezna.
Now let's get to the chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over David Rosenberg's picture that says Looking for the Downloads. Eric, let's cover crude oil, starting with the EIA inventory.
EIA inventory printed a drawdown of 4.6 million barrels, so fairly significant drawdown. Cushing, Oklahoma, 1.1 million barrel drawdown. Gasoline building 1.3 million barrels. Distillates drawing down 356,000 barrels. U.S. production holding unchanged at 12.3 million barrels. Tape action, the market had really taken a nosedive in the European session before the U.S. data even came out. Inventory was enough to arrest the plunge in the market, so it didn't continue any further. But it was not enough to turn the direction around to the upside, at least not so far.
Yeah, Eric, on page 2, I have the crude oil futures chart. And what we really saw, there was an attempt to break out of the trade range with that little push a week ago. But really what we've seen is a rejection at the top end of the range. And now we're filling that gap and backfilling. What's interesting is the fib retracement zones lie very close to where all the lows occurred in the last 6 months. And so the question is there still another $2, $3, $4 downside of crude? Generally, I think this trade range will still prevail, and that the dips should be bought here. But the question is that does it still have another couple dollars to go before that buying opportunity occurs? Nonetheless, what are you guys thinking on equities?
I'm still leaning toward the melt-up continuing for a while. If we get as far as 43.09 on the June S&P futures chart, then I'll short that level, expecting lower numbers before this is over. But I don't really have a strong view of whether we get all the way up there first before the rollover happens. Seems like more and more people, including Rosie in today's interview, are telling us, hey, second half, the shit gets real. That's when the recession really hits the tape. We're going back down in equity prices. Question is, how long do we keep drifting up before the top is finally in and we go back down? 61.8% retrace seems to me like the logical place, so I'm holding out for 43.09 before I would be bold enough to actually short this market, but I wouldn't be surprised if it rolls over before that.
So, Nick, on page 3, we've got the S&P 500 levels. What are you watching?
Spot right now is around 41.50 as we speak. There's a call wall above at 4,200 and a put wall at 3,800. Right now, the implied move for the May 19th OPEX, which is about a month away, is 140 points up or down. So the upper expected move is 290 approximately. Lower expected move is around 40.10, right above that support of 4,000. Key support is 4,100 and then 4,000. Key resistance area is 4,200. Interesting to note as well that this year, the S&P is up about 8%. And right now, there are about 20 companies that have made up 7.55% of that return. So there's Apple, Google, Amazon, Microsoft, NVIDIA, Tesla, Meta, and AMD, among others as well. So very, very interesting to note that because, a very small basket of names is carrying the market higher right now.
Yeah, what's interesting about that is the divergence also between small caps versus the NASDAQ. What we really saw, like you're saying, the leadership was in those big names. And because the Russell was filled with so many regional banks, it massively underperformed. And it was just such a huge laggard. And maybe that Russell is going to be a chart to watch in terms of when the markets are ready to roll over again. Now, on page 4, I have that S&P 500. And I continue to watch the two levels of overhead resistance. The market remains in bull trend. It's above all its moving average, above all the fibs, staying in that upwards trend. And that previous highs at around 4,200 have so far been the resistance points that has stalled all of these market advances. There is still room for one more advance toward 4,300. I know, Eric, you were talking about that fib zone that lines up with that August high. And it definitely, the market can get up there. The key thing I would say, though, which is an observation just in terms of how resilient the bulls can still be, is the fact that even 100 to 150 S&P point drop would keep the market above most of its key moving averages, above the fib zones, and arguably can still be bought on dip. There's a lot of technical damage that needs to be done in order for the prevailing uptrend to be reversed, and therefore this could easily push into May. But one thing that will certainly make me more bearishly inclined is that when we do see bullish impulses higher, if they continue to show this divergent momentum and a lack of follow through by the bulls, and the breadth of the market continues to be incredibly narrow, it's going to make me start to think that the downside window is slowly opening up. Will it be one of these sell in May and go away windows? It's kind of
Patrick, it's very interesting you say that, because I noticed the last 5 days on SPX, we've stayed in a very, very narrow range. The range has been about 17 points or so. We've closed right around that 4150 area for about 5 days in a row now. And seeing that before an FOMC event, which is in 2 weeks, I think we're going to see volatility pick up pretty fast. And you're right, it's possible we get upside to 4,300 or so. So I'm still short-term bullish, but longer-term bearish overall.
So let's move on to the NASDAQ on page 5. What are the QQQ levels you're watching?
So spot right now is around 317 on triple Qs. Call wall above at 350, put wall below at 270. Implied move for the May 19th OPEX, which is about a month away again, is plus minus 14 points. So upper expected move is 331, and the lower expected move is 303 approximately. Key resistance above is 320, and key support is at 300. Keep in mind, the high of the year was around 335. So if we do push that upper expected move, that will take us right to near the year highs or so. And we do have earnings from Google next Tuesday, as well as Microsoft. Next Wednesday, we have Meta reporting earnings. And then we have Amazon and Intel reporting next Thursday. And then the following Thursday, we have Apple reporting as well. So the heavy tech hitters are coming out in the next couple of weeks. That same week that Apple reports, we also have FOMC on Tuesday and Wednesday. So there's going to be a lot of volatility-inducing events, I think, coming up the next few weeks or so.
Interesting that you bring up volatility-inducing events, because when we look at page 6 on that VIX, what a surprising contraction of volatility. I mean, we are now seeing levels on the VIX that we haven't seen since 2021. And right now, essentially, the market's ranges have narrowed. Volatility premiums are very reasonable to buy downside hedges, and that really feels like nobody's worried about anything here. But it'll be interesting to see whether a short-term low comes in here on the VIX. What are you thinking?
Yeah, as I said last week, what we're seeing here is a lack of cash in the, being deployed in the market. So there's a lot of bystanders sitting on the sidelines, waiting to get in and waiting for a move in other direction. But right now, because of that, we're not seeing a lot of hedging to the downside with put buying, which is suppressing the volatility right now. So we're seeing some call buying, but not enough to push us higher, and almost no put buying right now for hedging. So that's suppressing the VIX. And as I said in the past as well, with the movement toward 0 DTE options versus the 30 DTE average options, the VIX is no longer perhaps as meaningful as it once was. Now on page 7, we have the US dollar index, which has seen a double bottom recently. What are you guys thinking we see going forward?
No change from last week. We're nicely holding in the consolidation zone. I don't see any reason to conclude that there's a really big new move down in the dollar unless and until we see a daily close below 100 on the Dixie, and we haven't seen that yet.
Yeah, Eric, the interesting thing for me here is there is definitely room for a couple more stabs on the downside, but generally I'm not as bearish the dollar as the consensus seems to be. And I feel that the prevailing trade range is far more likely to hold than another major leg down. At this stage, considering that the highs of the trade range are near 105 and the lows here are around 101, I think that seeing the dollar react and move towards the top end of the range has a very reasonable chance of occurring here. I'm far more neutral. It doesn't make me outright bullish the dollar. Simply, I think it's oversold. The support line has a very reasonable chance of holding, and we'll see whether or not we get a reaction here.
Now, guys, moving on to gold here on page 8, which is near all-time highs. I'm thinking we see a push higher and perhaps it's hit new all-time highs. What are you guys thinking here?
Well, the market is stuck between the round number support, used to be resistance, now it's turned into round number support at 2,000, and new all-time highs above the market. And let's say the resistance level above the market starts around 2060 up to 2080. One of those was the 2022 high, the other was the 2020 high. My prediction is that we will eventually get to new all-time highs, and when we do get there, I expect an acceleration of price movement to the upside. I don't think we're going to get there right away, though. It's just been so much so quickly for this market. It's never quite this easy. The market's got to make us work a little harder in order to earn our profits here. So I'm watching for a close below 2,000 to start a rout of lower prices before we eventually move higher to new all-time highs. We got the beginnings of that on Tuesday night, overnight into Wednesday morning when we were down to just over 1980, but then recovered to close over 2,000 before the close on Wednesday. I won't be surprised if the next move down ends up closing below 2,000 and starts a rout. And we've got plenty of room to the downside. As long as we stay over the 100-day moving average, which was all the way down at 1886, then we've got plenty of room here to say that the bull trend is still in play. So there could easily be $100 down before we eventually get the move to new all-time highs. But I do think that before the summer is out, we're going to have that move to new all-time highs, and we'll probably see a pretty substantial acceleration after that. Once you've closed over the previous all-time high, let's say above 2,100 to be safe, I think the trip to 2,400 from there will be very short.
Yeah, while I remain a big picture bull on the upside, and the way Rose even said it, 1 year out, do I see higher gold prices? I'm in that camp. I just am not so sure that it's going to be all upside here in April and May. As we bump our head up into this overhead resistance, the idea that we could mean revert this really amazing 5-6 month run on the upside is, I think, a risk, and we're going to see obviously where that presents buying opportunities, but I'm not so sure that this is going to be all upside from here. Nonetheless, I want to move on to page 9, where I have the 10-year U.S. government bond yields. And while we've seen yields increasing here on the very short term, I just don't see the environment from which we see, at least in the short term, a push back up toward those 4% levels. And so I suspect that as we work our way higher here, that it's likely to reject maybe even just below 375. It'll be interesting to see whether it creates a short-term buying opportunity on bonds. Moving on, though, I wanted to just touch on the high yield bond ETF, the JNK, which I have on page 10. And while we have seen a bounce and a reaction higher, which is largely due to its correlation to equity, there has been a lack of follow through. And to me, if we see that this failed to rally back to 94, where its highs were in January, February, and it rolls over here, to me, this is a canary in the coal mine of when the next risk-off cycle could really get underway, particularly if it causes those credit spreads to start to blow out. That has not happened yet, but it's certainly something on my mind to watch.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.